Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Markets are being driven by several key narratives right now. In China, after some initial stimulus, investors hoped for more aggressive fiscal measures, but the government has disappointed twice, holding back on significant spending. In the US, inflation came in higher than expected, reducing the chances of a 50 basis point rate cut and pushing up the dollar and yields. Meanwhile, the rupee has broken through the 84 levels despite strong reserves and solid macroeconomic conditions. Good morning, JK. Lots of market narratives are in play, and I haven't even touched on the potential geopolitical surprises. Interestingly, the rupee's breakout past 84 follows comments on what India will do with its strong forex reserves. What's your take on the current market moves?
Good morning, Saraj. It's like we look at, as far as the global market is concerned, we have to look at three things. One is China, another is the US economy, and finally geopolitics. On China, as you said, definitely there has been some disappointment. Over the weekend, people had been expecting some more big announcements from China, and that did not come. And they were specifically expecting something for the property sector. That did not happen. The only thing they announced is issuance of bonds for funding the capital of major banks in the Chinese economy. Now, also there was some other bad news from China. Inflation rates came much lower. The deflationary situation continued. The CPI, PPI all came down. But again, you can qualify it with the fact that these numbers were of last month. This was much before the stimulus was announced. Now, the price pressures or downward pressures obviously depend upon the consumption. And if the consumption is only expected to take off in the future based on the announcement that they have made recently, then you should ignore these deflationary numbers from China. So the Chinese markets have been volatile. They went up, came down. I think both Hong Kong and the Shanghai exchanges have been quite volatile after the big moves that has been seen in the last several days. Investors are not very sure whether we pick up further rally. I think it needs some consolidation. That's where the Chinese market is. As the US market or the US economy is concerned, PPI number, as you said, were higher year on year, but I think I'm more looking at the month on month number, which came lower. If you look at the headline month on month number, it was flat versus 0.1 expected. And on the core month on month also, it was 0.2 flat like last month. So I think the latest trend in the inflation, if we have to see, the month on month needs to be valued a bit. And that way, I think inflation was not, a big concern, at least as far as the PPI was concerned, though CPI came a bit higher. Market still discounts 87% probability of quarter percent in November and 85% of quarter percent in December. That has not changed. Yields, of course, are higher, mainly for the longer tenor. People are not sure. I think what is coming into play slowly is the fiscal situation in the US, which does not warrant you to keep the long tenor bonds in your portfolio too much. So they are shifting to shorter tenor. Longest tenor maybe up to 5 years, and then they hold the T-bills and 1 year paper, which gives good yield. That is how. So that's why you are seeing the yield curve once again, steepening. So longer tenor being higher and shorter tenor being lower. But that apart from PPI, we also had the Michigan preliminary consumer sentiment that came lower than expected last month. So again, people are concerned about the high level of prices, though the inflation rate itself might have come down. Actual prices compared to 1 year is much higher. People are having to spend a lot more on their day-to-day living than they used to about a year back. So that's led to consumer sentiment being weaker, and that's again a negative for the dollar. I don't think dollar made any decisive move on Friday. It's still awaiting some more clues. I think elections are nearing. We have to look at how the candidates are moving towards their ambition. As of now, it looks like Harris is losing some points. It's still a close race. I think we have to look at that. But this week we'll have a retail sales number also from US. That will be important for how the consumption is now moving forward. On the geopolitics, I think Israel, there were reported they had used some cyber attacks on the Iranian facilities, but that doesn't seem to have had much of an impact on the market. I think the real retaliation from Israel to the attack on them by Iran has not really emerged. Many believe that this can happen post US elections only. So that is something that will keep us on the edge for quite some time. So the currencies, as I said, were in a range, slightly weaker dollar on some currencies, and against the yen, it has been stronger because of the yield support. Gold and silver, consolidating, not knowing what's the next move on the US rates and also on the deficit part and the election. So too many questions on the US economy, keeping the dollar somewhat range bound. On the rupee, it was a surprise. 84 was led to fall because we are holding 84 for such a long time. At least on the face of it, there was no negative trigger for the rupee to have fallen below 84, but that did happen and traded quite some time above that. Not that, it was a momentary drop and it bounced off, although 84.10, we did hear the PSU banks offering dollars. Now the question is whether 84 fall is going to sustain or whether going to see a steeper fall. I doubt whether it will be a steeper fall because we are still having a central bank who is guiding the rates. On the whether we will quickly return or we'll be staying in a higher range, I think most of it will depend upon how the flows pan out in the coming days. If there are large outflows, which is quite possible. If not large, I think steady outflow is possible, considering it is the last quarter when FIIs take a profit on their portfolios. India is one of the best performing markets in the last 1 year. It has given 31.5% return as far as the NSE is concerned in the last 1 year, counting from last November. So you might well see in the next 2 months, FI is taking profit. And FI is taking profit, even if it doesn't affect the equities, it still affects because outflows mean that you have more demand than supply. So rupee my balanced view would be that rupee stays in a slightly higher range. Maybe the lower side is defined by 83.90. Upper side is defined by 84.30. So I think that is where we are in the new range, and we look to see how other global factors move to determine whether rupee has a larger move. Thank you.
Thank you, Jake. And just quickly summarizing, for China, there was a disappointment once again when it comes to stimulus over the weekend. There was expectation of property sector stimulus that did not come. Deflationary situation has continued. CPI, PPI was down. But these are all pre-stimulus numbers, so they can be sort of kept aside. For the US market, as JK mentioned, PPI was higher year on year, but the month-on-month numbers was flat. In the latest trend, month-on-month numbers needs to be valued more. Markets discounting at 25 basis point rate cut each during the November and December meeting. Consumer sentiment was lower than expected, but this week retail sales will give a better idea on the consumption side of the economy. Overall, currencies were in a range. Gold and silver consolidating. For rupee, a break of 84 was a surprise since it was held for a long time, but there was no negative trigger for it to fall. Now, question is whether 84 break will sustain. Dependencies will be on the flows. If large outflows persist, it can result in a weaker rupee. Since India is a very good performing market, the equity market, in the last 1 year, there may be some sort of profit taking by the FIIs. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.